Hello. Good morning, everyone. We will wait a few more minutes before starting. Let's take about 5 minutes to allow everyone to join account for any slide delays. Thank you. Okay, we can get started now. I think is good for the contribution. Good morning, everyone, and welcome to the India-Italy corridor. This webinar has been jointly designed by Grant Thornton Italy, Grant Thornton India, and SIMEST with a very clear and practical objective to show how Italy and India can develop structured cross-border growth, combining advisory, execution on the ground, and financial support. About the speaker, my name is Ferdinando Greco, partner at Grant Thornton Italy, and I will be pleased to guide you through the first part of today's webinars. I'm joined by three other speakers who will bring complementary perspective along the Italy-India corridor. If possible, I would like to have the slide with the speakers, please. Okay. Fabrizio Ceccarelli, Chief Representative India for SIMEST, Sante Maiolica, Advisor Partner and Head of M&A from GT Italy, and Christian Arora, Partner in Direct Tax e India Investment Advisory, Service Leader in GT Bharat. Grant Thornton, both in India and Italy, brings to this project an integrated market perspective, combining strategic, tax, regulatory, and operational expertise, and supporting the companies throughout the entire cross-border entry and growth journey. SIMEST, on the other hand, will later present its role and the financial support it provides for international investment, working in close alignment with our advisory execution activity. About the agenda, today we will start with a snapshot of India-Italy trade and the broader European-India FTA context. And then we move into strategic opportunity and practical tool along the India-Italy corridor, including SIMEST support. And before closing with the Q&A section, if you want, you can submit about this webinar some question in the chat box. We are pleased to answer at the final section. Before moving to the number, I would like to add one important element of the context. The current trade and investment relationship between India and Italy should also read in light of the renewed momentum on the European-India Free Trade Agreement. After several years of pause, negotiations have been relaunched, and the company are positioning themselves early, especially in sector where Italy is particularly strong, and this give additional meaning on the number we are about to see. With this context, we are now move in the slide 5, where the India-Italy trade investment snapshot. This slide gives us a very clear picture of where the relationship stands today. Bilateral trade between India and Italy is around 14 to 15 billion euros, and it is remained stable during 23 and 24. This tells us we are looking at a solid and resilient commercial relationship, not a volatile one. Within this total, Italian exports to India are approximately 5 billion euro, which confirm a strong presence of the Italian product and technologies in the Indian market. At the same time, India maintains a trade surplus with its European partners, reflecting the strength of its industrial and export base. But if we move to the investment landscape, the data become even more concrete. In fact, there are more than 800 companies active, Italian companies active in India, with an Italian FDA stock of about 6.9 billion euro and employing around 60,000 people through Italian firms in operating in the country. This number show us that Italy is already deeply embedded in the Indian economy, and at the same time, as highlighted in the slide, this strong base still hide significant untapped growth potential. Let's now move to the slide 6. Two powerhouses and one corridor. This slide help us to explain why this potential exists. On one side, we have India. India is today a $3.9 economy, the fourth largest in the world, growing at around 7.2% per year, with a population of about 1.45 billion euro, the largest consumer market globally. On the other side, we have the Italy. Italy is a $2.1 trillion economy, the eighth largest globally, with merchandise export of about 626 billion dollar. And within this global footprint, bilateral trade with India stand at around 15 billion euro. What we clearly see here is complementarity, because India offers scale, growth, and a massive domestic market. Italy offers industrial excellence, specialization, quality manufacturing, and export capability. This is why we talk about two powerhouses connected by one corridor, rather than two standalone markets. Let me close this first section with a final thought. The relationship between India and Italy is already strong, stable trade, significant investment presence, clear sector alignment. At the same time, the renewed momentum on the European and India FTA create expectation of improved condition over time, especially in sectors such as machinery, automotive, chemical, luxury good, and alcohol bev. For companies interested in developing this cross-border market, the environment today is favorable and offers strong prospects. Our role is to support and guide every aspect on this journey, from strategy to execution. This is the purpose of the India-Italy corridor built by Grant Thornton Italy, Grant Thornton India, and SIMEST. Sante, what do you think about this section? And I would like to have some your practical insight about this.
Thank you, Ferdinando. But to bring these numbers to life, I want to share a quick conversation I had recently with the CEO of an Italian automotive component firm that is it is one of my clients. In particular, he produces spare parts for industrial vehicles, and he operates at a global level. He told me that for years he viewed India as a dream market, but protected by a fortress, primarily due to the 110% duty on high-end vehicle and parts. So he told me, Sante, we aren't just fighting competitors, we are fighting the math. And I think that according to what you said today, that math has changed. So we do this dropping to 10%. I will see in the webinar, in the next part of the webinar, dropping to 10%. That fortress is gone. So I think that this is the strategic insight we see on this webinar today. So we are moving from a period of untapped potential into a period of unlocked competitiveness. So our clients are no longer just exporting to India. I'm speaking from the Italian side, of course, no? But I think that for the Indian is the same. So our clients are no longer just exporting, but they are integrating into a global value chain where probably Italian excellence is finally an accessible premium. This is my view.
This is the way I think I share with you, because I think it's very important to create a real synergy with the two markets in order to grow together. Thank you, Sante, for your case study. And I now pass the floor to Christian for the second section of our webinar. Thank you very much.
Thank you, Ferdinando and Sante, for setting the context. And a very good morning and good afternoon to our attendees from India, Europe, and other neighboring countries who have taken out time to attend the webinar. Talking about this slide, I think Ferdinando mentioned that the EU-India Free Trade Agreement hasn't been a quick process. It's been a more than a decade-long journey of negotiation and alignment. Negotiations first launched back in 2010, but after the talks were suspended in 2013, we entered a long period of dormancy. The real turning point came in 2022 when negotiations were relaunched with fresh energy. In 2024, significant political momentum was gained with a clear goal of reaching a conclusion by 2026. Given that this agreement was signed on January 27th of 2026 at the EU-India Summit in the presence of the Honorable Prime Minister Modi and the EU President Ursula, and it was expected that the administrative process to implement the agreement will conclude before this year ends, and the provisions will come into effect in 2026 itself. The FTA provides a significant boost to Indian exporters who will receive preferential access for over 99% of exports from India to Italy. This is significant given the large market Indian goods has in the European Union, while the benefits which will come into effect in a gradual manner, over 70% of the tariff line items will be liberalized immediately. And specifically talking about India-Italy trade, that is expected to be a game changer for several labor-intensive sectors like textiles, leather, jewelry, where high tariffs have historically been a hurdle. With FTA coming into effect, I would say enhanced market access will create a demand for the goods in the Italian market. And in a nutshell, Indian goods will become more competitive in Italy and obviously in the larger European market than ever before. And beyond tariffs, the FTA also opens door for a strategic partnership between the two large economies, which is also expected to have a very positive spillover effect into multiple areas. This may mean, increased cross-border investments, strategic alliances, common vision for growth in identified sectors. And FTA is just beginning of that growth journey, I would say. A major one for our Italian partners is the protection of the geographical indications, GIs, in the Indian market. I think the biggest change for which is going to happen also is from a food and wine exports, ensuring that made in Italy maintains its premium status and legal protection. And strategically, this FTA would reinforce the EU-India partnership and strengthen global supply chains as well. It will position India not just as a market, but as a central manufacturing and a service hub. Next slide, please. And talking about some of the key schematics around the FTA concessions that one should be aware of. Every FTA provides certain guardrails to ensure benefits are provided only where due and not blanket benefits to all exports going out of the country. This would mean keeping checks on the eligibility of the products, ensuring due declarations to validate the sanctity of the claims and the compliances at the end of the importer as well as the exporter to create an audit trail. And for this, there are three important areas around compliances which are relevant. This is origin determination, certificate of origin, and import compliances. Origin determination is the primary criteria for claiming any FTA benefits. And without this element, the benefit of FTA cannot be claimed. Origin is evaluated through a rigorous lens of both general and product-specific lens, the rules framed therein. This involves a very deep dive into the technicalities of the manufacturing process, looking at regional value content and the change in tariff codes. Essentially, customs and regulatory authorities look out for substantial transformation in the product along with other parameters to confirm whether the FTA benefit is available or not. And we will discuss this in further detail in the subsequent slides. But it's important to remember that product origin is the primary criteria for claiming any FTA benefits. And without this element, the benefit of FTA just cannot be claimed. Second, the certificate of origin becomes the documentary proof of origin for a particular product. Obtaining this, requires validation of cost statements as well as manufacturing processes, which are effectively part of the origin determination process. The only determination or the difference is that self-determined origin is required to be substantiated to the authorities, along with the requisite documents to obtain the certificate of origin. And from an operational standpoint, one should keep in mind that while manufacturing process might only need a one-time approval to be FTA eligible, one is typically required to secure a fresh, unique certificate of origin for every single shipment. This ensures a continuous and a transparent audit trail for the customs authorities on both sides. And lastly, the import compliances also vary from country to country and are often beyond the provisions of the free trade agreement. These are generally rules which are laid down in the local country level status and the statutes. Like in India, we have got Karatar. Similar rules may exist in every country, putting a reasonable burden on the importer to ensure only legitimate FTA concessions are being claimed and a reasonable diligence is in place to ensure that. Can we move to the next slide, please? Going a little deeper into the criteria of the country of origin determination, there are three typical criteria often to be satisfied, which is cumulative for a product to obtain originating status under the FTA. And these are number one, achieving a minimum regional value content, which has to be value addition, change in tariff codes for non-originating inputs, and substantial transformation from an input to finished product perspective. One must also satisfy the regional value content by using either the build-up or the build-down formula to meet the minimum local value addition requirements. And essentially, both these methods aim to check the value addition locally as against the requirement prescribed under the FTA. I'll take an example for that matter. In the India-UK FTA, it's provided that 40 to 45% requirement for value addition for the local value content. The ASEAN FTA provided 35% requirement, and similarly, other FTAs also provide a specific threshold to be achieved for this criteria. Second comes the tariff code change. The typical requirement here is any non-originating input going into the final product should suffer a tariff change, leading to the change in the tariff code of the input when compared with the tariff code of the final product. This can be a 4-digit level as defined in a particular FTA. And lastly, substantial transformation rule ensures the product has undergone a proper manufacturing process rather than a simple assembly or a simple process. And given all this, it is important to be aware that the product-specific rules often exist, which act as a specialized benchmark that override general rules for certain types of goods. In such cases, the general qualifying value content criteria also may not apply, which means it's also important to consider logistics and non-product element of the shipment, etc. And most agreements mandate direct shipment, meaning goods should travel directly straight from the country of origin to the importing country to avoid any questions about tampering or substitution in a third country or a third territory. We will now pick up some specific impact from a sectoral perspective. I think this is very important. And from an India-Italy perspective, where trade is expected to really gain volumes due to this free trade agreement coming in. And the first sector we'll talk about is automotive. Sante mentioned an example talking to his client. I'll talk about some specific aspects of what could be expected in the automotive sector to start with. And then the immediate game changer for the auto sector is the dramatic reduction of the import duties. We are looking at tariffs on high-end European cars, tariff crashing from 110% down to 10%. This effectively levels the playing field for luxury and high-performance Italian brands, making them significantly more competitive against the locally assembled premium vehicles. Brands like Lamborghini, Ferrari, which are dream cars for many luxury buyers in India, are likely to become accessible to more such buyers with duty cuts that would result in an overall price reduction of the cars, which will relatively be less damaging on the pockets, I would say, from an FTA coming perspective. Same would go for many high-end Italian bikes for bike enthusiasts in India, which are many now. Not only from an India perspective, but this also means that there is an increased business opportunity for the Italian manufacturers looking to expand the automotive segment into Indian market, which actually has the right fondness for good cars and bikes, leading to a win-win situation for both the countries. And I'll move to the next sector, pharmaceutical and medical devices sector. And FTA is proposing total removal of duties from around 11% to zero in a phased manner over the next 5 to 7 years. Even more significant is the drop for medical and surgical equipment, falling from 27.5% to zero. And this drastically lowers the cost of high-end Italian medical tech in India. It's a major win for the healthcare affordability and will give Indian providers access to world-class diagnostic and surgical tools with almost zero duty burden over a period of time, and making this technology available for end consumer at a much lower cost. If I talk about machinery and electrical equipments, that's another important sector. This will also see significant duty reduction with duty elimination on majority of machinery and electrical equipment under the FTA. This is expected to give boost to Indian manufacturing sector as well, with availability of high-end machinery from Italy at zero duty cost. FTA commitments are also backed by long-term investments into India. So by removing tariffs on advanced machinery, we are fueling much required India's industrialization, modernization, supporting not only the Make in India vision of the Indian government, but also helping Indian businesses make up a place in the global value chain. And the focus is on smart factories and digitization, allowing Indian manufacturers to integrate Italian precision of engineering at a much lower capital expenditure. Moving to the next sector, chemicals. Duties are set to drop from 22% to almost 0% across almost all lines. This move will also focus on specialty chemicals and low carbon solutions. As India pivots toward green energy and sustainable manufacturing, Italian specialty chemicals will become essential, cost-competitive inputs for the Indian value chains. Moving to a very important sector, the luxury goods segment sector for Italian products, which entails a niche interest from Indian buyers. I think with a steady growth in the past decades and high disposable income in the hands of the Indian consumers, India is seeing a significant surge in demand of luxury goods in recent years. And many of these requirements were earlier fulfilled by global travel retail to save on any duty costs. And as per the current expectations, the complete elimination of tariffs from almost 22.5% to zero on items like pearls, precious stones, and metals, and this could extend to many other luxury products across apparels, accessories, etc. This is a significant portion of imports, which is likely to boost luxury good market from Italy to India and help increase the retail footprint of high-end Italian luxury brands coming into India or operating in India. As we know, Italy is a global leader in high-end design and luxury brands. This reduction positions Italy as a premium partner for Indian booming luxury industry and creative economy. It's about more than just products. It's about integrating the Italian aesthetic leadership, I would say, into the Indian premium lifestyle segment. I'll take an example here. International luxury brand like Prada had recently, it was in the news that they partnered with Indian local bodies to create a limited edition line inspired by traditional Kolhapuri chappals. From an FTA standpoint, this is a value add strategy, I would say. By leveraging the zero duty regime on high end Italian raw materials and the design IP and combining them with Indian artisanal heritage, brands can actually create global Indian products that qualify for preferential origin. This isn't just about selling made in Italy to Indians. It's also about using the FTA to blend Italian aesthetic leadership with that Indian manufacturing, creating a high margin export hub for the global luxury segment. And that applies to both Italy and India. Aspirational brands like Gucci, Armani, Versace would be available to increase outreach to the affluent Indian customers. With increase in Italian, Indian higher middle class, the market is ever growing, and this will further grow once the FTA concessions come into picture. Last but not the least, and a very important sector would be wines, spirits, and cosmetics. I think one of the most dramatic drops in duty tariffs is expected in Italian wines, crashing from almost 150% to about 30%. And additionally, about 22% tariff on cosmetics is expected to be phased out within 5 to 7 years. This targets the retail sector and the high growth hospitality covering the hotels, restaurants, and cloud kitchens, commonly called as HoReCa. By slashing the luxury taxes on Italian wines and beauty products, we are making premium Italian lifestyle brands accessible to India's expanding middle class and elite consumer base. As I mentioned, one of the most transformative impact of the FTA will be seen on the tariff changes when wines and spirit sectors changes come into picture, with 150% prohibitive duty is going to slash to 30%. From an investment perspective, this is just not a price cut, I would say. It is a category relaunch. Just to give an example, under the old regime, a wine like Italian Prosecco was a high margin, low volume, special occasion drink, largely which was confined to Italian, elite gifting or, consumption for the elite. But with the FTA-led reduction, it will become a by the glass staple across India's rapidly expanding hospitality sector. And again, if I talk about cosmetics, similarly, the gradual elimination of the 22% tariff on cosmetics, brand like Kiko Milano, over the next 5-7 years is a major win for the made in Italy beauty sector, which is already seeing a 33% surge for exports to Indian market. And from an FTA perspective, the duty drop will allow Italian brands to move from being imported niche to accessible luxury in India. So I can easily say that India EU FTA is much more significant industrial and lifestyle play, specifically when compared to India UK FTA, which is often seen as a landmark for services and financial mobility. And particularly for the Italian corridor, this is very important because, for instance, the UK deal focused heavily on reducing duties for, say, Scotch whiskey. The EU agreement offers even more aggressive concession for the Italian wines, with that reduction coming down to 20-30%. Furthermore, the UK deal served as a gateway for Indian software talent. The Italy EU corridor is designed for hardware and Industry 4.0, prioritizing the duty-free movement of high-precision machinery and luxury automotive components, for example. And it's essential to view India-EU FTA not in isolation, but a strategic upgrade to the India-UK deal, which was signed in 2025. With UK agreement focused, like I mentioned, on services, professional mobility, the EU FTA offers a deeper industrial integration. And for the Italy-India corridor, the tariff concessions like these will happen on premium segments as well as on the manufacturing sector and other sectors which I talked about. And that is a catalyst, I think, from a perspective of the industry, and it is spanning across sectors. And as I just mentioned, a few examples of those, these are strategic sectors. This will definitely have a very important increase in volumes of imports into India, exports from India, and so on and so forth. From that perspective, I think the accessibility to the Italian machinery, the automotive technology, all of this will become backbone for making India scale up. And from an investor, if the UK deal was about software and talent, the Italian partnership through EU FTA is about high precision infrastructure and luxury heritage. And having discussed the overall schematics and the sectoral impact, now let me bring my colleague Sante and request him to speak about the strategic opportunity that possibly emanate from companies looking to utilize the benefits from the FTA perspective. Back to you, Sante.
So thank you, Christian. I think that your speech was self-explicative because just listening at what you said, I think that is quite easy to understand the horizon, the huge horizon of opportunities this FTA is creating and will create, of course. So in any case, we have identified the core growth drivers of this agreement. And of course, in a nutshell, we are seeing a really strong integration in both manufacturing and services, I think fueled by the expansion of European Union and India value chains. But what are the high impact sectors according to our view? For sure, Industry 4.0 and all the related advanced manufacturing segments. These two environments are, in our opinion, the forefront of this agreement. Of course, followed closely by automotive. We mentioned it several times during our webinar, and I think that automotive is probably one of the key elements will be impacted from this agreement, and we believe it will be absolutely a huge opportunity for the Italian district and the Indian district on that. But also, I think all the related mobility ecosystem that is just not automotive. It is something wide, something huge. We also see, I think, massive potential in the green transition that, is impacting the European Union, but the India environment is absolutely linked and related, and also the agro-food technologies. So we are investing a lot of money on agro-food. We are trying to rethink at this sector, especially in Italy. I think that with the Indian support, we will create, I think, a massive disruption in terms of technology impact on that. But at the end, how do we move from signal to scale? Because the point is to be concrete and to be effective. So the enablers are clear, in my opinion. We now have reduced the regulatory barriers, as you said. We improved IP protection, that is quite important, especially for the know-how contamination between the two countries. But the most importantly, we have a new level of investor confidence. Okay, we have also a very high level of predictability. This is fundamental. So this is, I think, the foundation upon which Indian and Italian companies can build a long-term cross-country strategy.
Absolutely. I think thank you. Thank you for that thought, and I completely echo with that. And you rightly mentioned, stages set in terms of the enablers, which we can already see, and having discussed some of the insights, I think all of us agree that this is a large opportunity from, both India and Italy from a strategic partnership standpoint, and a lot of more conversations will happen around those between people who are willing to invest both sides and look at creating those alliances. But I think it's important from also then what has come out as saying that signal to scale. There has to be an action plan around it, and that's exactly what we'll cover in this slide. I think in my view, the strategic outlook is centered on rapid expansion of the EU-India value chain, for that matter. We are witnessing a fundamental shift from the traditional trade towards deep-seated integration in both manufacturing and services. By building these resilient supply corridors, we are just not, we're not just moving goods. We are friendshoring critical components for the economy, combining the European technological precision with India's unparalleled ability to scale production from a global market standpoint. When we look at high impact sectors, we talked about those. The synergies are pretty clear across, some key pillars. In the Industry 4.0 and the automotive ecosystem, we are merging software expertise with advanced hardware to lead in smart mobility and automated manufacturing, for that matter. Simultaneously, our focus on the green transition and agro-food technologies addresses global imperatives, and this will leverage collaborative R&D to drive innovation in clean energy, sustainable food processing that can be exported worldwide. And finally, I would say that the success of these initiatives rests on key policy enablers that provide the rails for the growth. By aggressively working to reduce tariffs, aligning the regulatory standards, and strengthen the IP protections, we are actually removing the friction that historically slowed the cross-border ventures. This transition towards a more transparent and predictable environment is designed specifically to boost the investor confidence, as you also mentioned, ensuring that long-term capital feels secure in these high growth corridors. I would now request Santi to, if you come back and you would like to add anything what I mentioned on the strategies, but also take us to the next section on how we are looking at this opportunity seamlessly for helping our clients as a one team from Italy and India corridor perspective. Over to you.
Okay, this brings us to the how finally. So looking from an Italian perspective, but I guess it's the same also for my Indian colleagues. India and so Italy is a strategic necessity. From the Italian perspective, I want to be clear, it's not only because of China, because it's a completely different situation. India is a strategic necessity for all the reasons we have listened during the webinar. But India is far from Italy. India is huge, is bigger than Europe. So I also speaking with a lot of Italian entrepreneurs, and for many of them, the fear of unknown, just to give you an example about the regulatory maze, the geographical distance. So that are the typical internationalization process issues that normally we face with companies that want to be abroad. In this specific case, can be paralyzing. So this is why we created the Grant Thornton India-Italy corridor. No, also thanks to Simest support. So we synthesize in this slide as we operate as a single integrated platform. In Grant Thornton, we have a very common and standardized way to work and way to approach the market. In India, like in Italy, we act in the same exactly way. So we combine local execution in both markets, okay, with strategic, legal, operational expertise. Exactly the same in Italy, like in India. So whether you are a machinery SME facing with I don't know, the new 10% tariff, or we were speaking about the automotive sector, or for example a textile leader, no, seeing the European Union duties removed. We provide an end-to-end guided approach, so is a full range support we provide to local and to entrepreneurs, to clients, and so on. So we don't just give a legal opinion, a tax opinion, an advisory support, an M&A assistance, a vendor assistance. No, we provide a roadmap. So we define together a full roadmap. And it is, I think, fundamental, and it's possible only if you are a fully integrated advisory firm. No, if you move to the next slide, you can see the GT way. What we define the GT way, and we identify this path, this route, in 5 main steps. So the first one is, of course, the FTA advisory. We spoke a lot about the FTA. In any case, the advisory we provide on the FTA issues on topics are quite simple. So in a nutshell, we optimize the tariff and all the digital certification. So all the administrative issue will be managed with our integrated approach. The second step is related, of course, to market entry and the partner scouting. This is very important. And how do that? Simply finding the right partner through the compatibility analysis. So in Italy, we have the same environment, the same database, the same way to approach the network, the same way to valorize the network. So we are able to find the right partners according the criteria and the desire of the client, speaking directly with our local offices and local firms. On the ESG and CBAM compliance, that is probably one of the most new topic we are facing with. Our approach is to ensuring that your supply chain meets, of course, the new green standards. We have the same protocols. We have the same way to go in depth on that protocol. So, for example, we provide the carbon reporting, the supply chain adoption. So all the measures we have to face with in order to be ESG and CBAM compliant. Another step is about the IPR and the professional mobility. We spoke before about the opportunity and the need to protect the patents in order to facilitate the transfer of technology, the transfer of know-how. It is something that is absolutely core for example, Italian companies that are investing today in India or are going to invest in India. So we will have all the tools in order to protect patents and, of course, to handle visas, also for the secondment and the mobility, also pro tempore of the staff. The next step, and I think that this is our differentiator, and not only because I'm a finance guy, but because it's a matter of fact, corporate finance and SIMEST partnership. So we act as institutional bridge for our clients, for the companies, in order to provide them the funds to realize the investment and to realize the strategy in order to facilitate the cross-border activities with India. So speaking of funding and strategic support, this is probably the perfect moment to switch to our next guest, to our special guest, that is Fabrizio from Simest, and to talk about the financial engines behind these opportunities. So Fabrizio, I will leave you the floor, and thank you for your presence today here.
No, thank you. Thanks to you, Sante. Thank you very much to you and the entire Grant Thornton team for organizing with us, with Simest, this event. For me, it's a real pleasure, of course, and thanks also to all the companies that are connected with us today. So, as Ferdinando said at the very beginning, let me just start with a very quick introduction to Simest. So Simest is the Italian government agency fully dedicated to supporting the internationalization and export of Italian companies. We are part of the Cassa Depositi e Prestiti Group, CDP, Italy's development bank, or sovereign investment institution, as you want to call it. We operate through a combination of public and institutional resources, primarily on behalf of the Italian Ministry of Foreign Affairs and International Cooperation, so Ministero degli Esteri in Italian, but also through European funds, in collaboration usually in this case with the European Investment Bank or with our own balance sheet. Our role is basically to do in parallel similarly with what Sante was describing for GT, to accompany the Italian companies, of course, across all the stages of their international journey. So from the initial export phase to a first market entry, then the expansion, and then a long-term consolidation on the foreign market. So now, how we do see India today? So before moving to the products and the instruments and solutions that Simest can offer to you, how we see India and why is the Italy-India relationships so important, so strategically important. So the answer is clearly represented by two major frameworks. One, of course, is the EU-India Free Trade Agreement that we are describing today, and the other one is IMEC, so the India, Middle East, Europe corridor. From the Italian government perspective, both are extremely important. IMEC is critical because it strengthens Italy's natural role as a logistic hub and a strategic platform in the Mediterranean. And this is relevant for what Sante was saying, with reference to the fact that it's not just seeing India as an alternative to China. It's actually to gain a more prominent role for Southern Europe. And of course, Italy in that case would be probably the best positioned country in that sense, for the entire support of a more distributed and more homogeneous growth in Europe, and relationship with, of course, with Asia Pacific in general. The FTA, the Free Trade Agreement, is equally crucial because Italy is the second manufacturing country in Europe after Germany, and exports remain one of the main pillars of our GDP. So we don't have to forget that at the end of the day, Italy is the fourth exporting country globally, considering the size of the country and of the labor force. It's almost incredible. Beyond geopolitics, what I also want to stress is that the relevance of India for Italian companies and vice versa lies in the strong industrial complementarities between the two countries, something that we have already heard today. So Italian companies bring advanced manufacturing expertise, technology, design, specialization. India offers scale, industrial ambition that is also reflected in a very recent and less recent decision by the government and the agencies that are guided, of course, by the Indian government, and a fast-growing consumer market, and an increasingly sophisticated demand for qualities and standard. Honestly, until 1 or 2 years ago, and I think I'm a bit repeating what Sante already said, 1 or 2 years ago, I could still understand why some European, especially Italian small and medium enterprises could be a bit hesitant, about entering India, considering maybe that it was a bit too early. But today, honestly, I do no longer see any valid reason to wait. India is already a massive market with a strong urbanization dynamic, with a rapidly growing middle class, increasingly growing in terms of purchasing power, with a greater attention to quality and standards, maybe for a small percentage of the current population, but that percentage is growing, and in any case is applied to a base in terms of customers that is already huge. Stronger industrial regulations, just think about the BIS certifications, a solid Make in India policy, and now with the EU-India Free Trade Agreement, of course, progressively lower tariffs and fewer economic barriers. And this, of course, changes completely the context. From SIMEST perspective, what we have seen so far is naturally a strong concentration of Italian investments in heavy industries, of course, automotive, chemicals, electronics. We need more not to be localized in a foreign market to serve that specific market, or maybe neighboring countries. These sectors, for sure, will still continue to grow since they are central within the Italy-India joint strategic action plan, and in any case will benefit from, as has been said already, will benefit from the kick in of the EU-India Free Trade Agreement. But what we are now expecting is a significant acceleration in many additional sectors with a more consumer-oriented rationale rather than purely labor cost-driven. And this is something that we are already perceiving. Maybe it's taking still a bit of time, but it's something that is coming. So companies active in the luxury sector, design sector, food and beverage. When I say food and beverage, of course, I refer to processing, packaging, cold chain, pharma, semiconductors, energy.
Oh, yeah, I think we lost Fabrizio for a bit again.
Okay, let's wait a couple of seconds in order to understand if he is able to solve his technical issues. Otherwise, we can move to close our session. What do you think?
Yeah.
Okay, I think that Fabrizio is facing with several technical issues. So what I can suggest is to invite people who attend the webinar to ask us any kind of question. If someone want to go in depth on any kind of specific topics. The idea is, in any case, to collect all the questions you address to us, and we will answer to you also via email or sharing the Zoom platform. In the meantime, if you agree, I can try to address to the speakers. Fabrizio, are you online?
Yes, sorry, I don't know what happened.
So, sorry, we lost you. If you don't mind, Fabrizio, because we have 5 minutes left, we will try to address a couple of questions to you. And
no, sorry for that.
okay, so I will start with you, Fabrizio, if you don't mind. So the first question I have is how do the public-private risk sharing mechanism mentioned in the action plan can help Italian companies to mitigate financial barriers and of market entry?
Okay, Sante. So first of all, please excuse me for the problem with the connection. But I mean, probably this question is helping me a bit to just explain some elements that I would have discussed in the final part of my speech. So the India-Italy Joint Strategic Action Plan basically contains several provisions that point in this direction, also in terms of having a sort of institutional support in order to reduce the risk and mitigating the entry barriers for Italian companies. But again, this is more translated in institutional support, industrial partnership, investment facilitation measures in general. So in particular, regarding the institutional support, there is a deeper coordination between the financial arms of the Sistema Italia, so SACE, that is the Italian Export Credit Agency, is more to issue financial guarantees, insurance policies. Cassa Depositi e Prestiti is with a lending role, is a financial lender. And then SIMEST, of course, that I didn't say, but basically support the Italian investments through equity solutions, so reducing your exposure in terms of equity for your investment abroad, or with soft loans, so supporting your company with loans with a very low interest rate in the range of 0.3%. And this is all with a strong cooperation with local institution, for example, like investment.
Okay, we lost Fabrizio again. I'm sorry for that. If you hi Fabrizio, are you online?
Yes. Sorry, I think that there is a problem in general here in the building. In any case, I just finished with my intervention. I just wanted to say that again, this is more the approach is more of a higher coordination between the agencies of the Italian government and more complementarity among the instruments that they can offer.
Okay, thank you very much. Quite clear. So before I have a question for Christian, but before to address my question to Christian, I want just to notify to all the attendees that we would be happy to dedicate a pro bono session for the first 10 clients or people who is attending the webinar in order to provide again a pro bono initial assistance about FTA, about the Indian-Italian corridor, about all the activities we mentioned during our webinar. So if you want to have an interactive meeting with us, just ask via chat. We will be more than happy to dedicate this pro bono session to the first 10 who will book about that. Switching to Christian, so I have a question for you, Christian. What is the expected timeline for the FTA's implementation, and which specific high growth sector are poised to benefit most from the initial phase of tariff liberalization?
If you ask me, Sante, my wish is it happens immediately, but there is a process around it. So we have to wait for some more time because the date clarity is still not fully covered, but I think we can take some cues. From various corridors, we understand that they're targeting the year end to actually complete all the formalities to actually have the FTA see the light of the day. It also coincides typically with the implementation timelines. We have seen India has followed, when FTAs were signed in recent past also. That much time has been taken. So I'm assuming and hoping that within this year it should happen. I think we talked about sectoral growth and we covered a couple of sectors. And, all of you also mentioned some of the examples around those. So automobile, pharma, chemicals, luxury goods, wine, liquor. And these are the sectors I think will see an immediate turnaround, within the FTA because of the potential it has to really scale up and grow as far as both countries are concerned. And these sectors are, the benefits which these sectors are kind of poised to provide from the initial phase are labor-intensive industries where high tariffs have historically acted as a significant barrier. So I'm also hoping that textile, leather, and other jewelry and other things will also have immediate cost reductions, but this will make Indian products, equally competitive in the European market than ever before. So I think as of now, these are the sectors which probably would be the first focus, and I was hope that we see the FTA being operated within this year.
Thank you, Christian. Quite clear. Thank you very much. Because we are out of time, I will address a last question to Ferdinando, my colleague from GT Italy. So Ferdinando, you talked, but we also talked about these two strong economies, India, Italy. But in a nutshell, what does this corridor mean in practical terms for a company?
Of course, thank you, Sante, for the question. In very practical terms, the corridor means not going alone. For a company, it means having one coordinated framework that brings together market understanding, regulatory and tax guidance, local operational support, and moreover with our colleagues of SIMEST financial instrument. Instead of dealing with each aspect separately, the corridor approach and help the company connect all pieces into one structured path, reducing uncertainty and execution risk. The objective is to make the Indian market more accessible, more manageable, and more predictable, especially for the company approaching it for the first time.
Okay, clear. Thank you very much, Ferdinando. So if you agree, I will conclude our session. Please stay connected with us. Here you can find our address, our email address. So please feel free to contact us for any need any need to go in depth about what is said during the session. Again, we will be more than happy to dedicate pro bono sessions to the first 10 people who will ask after the conclusion of the webinar. I will really thank you, everyone, GT, India, and SIMEST in particular, to organize with us this webinar. Thank you, Manashi. Thank you, Christian, Ferdinando, and also Fabrizio. I don't know, Christian, if you want to add something. Ferdinando, you too.
Thank you. I think nothing else. Thank you, and I hope everybody got some more insights in terms of what we shared, and we'll be happy to engage, as you just mentioned. So, in the interest of time, thank you very much.
Thank you very much. Nothing else. I'm joined with you, Sante, for your expression. I'm very happy to be part of this project and to be support the company for the next future.
Yes, thank you to all of you.
Thank you.